Today I'll be talking about small and medium enterprise, also known as SMEs. SMEs are businesses that fall between small businesses and large corporations. They are usually defined based on factors like how many people they employ, how much money they make, or the value of their assets. Even though they may seem small compared to big companies, SMEs have a big impact on the economy. They create jobs, support innovation, and help local communities grow. In many countries, they actually make up the majority of businesses.
Let's talk about what defines a small and medium enterprise or SME in Malaysia. SME here are classified based on two main factors. First, the annual sales turnover, and second, the number of permanent employees. There are two main sectors we are looking at. The first one is the manufacturing sectors and the second one is the services and other sectors. For the manufacturing sectors, a small enterprise has sales between 300,000 ringgit and less than 15 million ringgit, and it employs 5 to fewer than 75 employees. A medium enterprise earns between 15 million ringgit and 50 million ringgit and employs between 75 and up to 200 people. For the services and other sectors, a small enterprise also has sales between 300,000 ringgit and 3 million ringgit and hires between 5 and less than 30 employees. A medium enterprise earns between 3 million ringgit and 20 million ringgit with 13 to 75 employees or fewer. So in short, SME are defined by their size, not just in revenue, but also in how many people they employ. Let's now explore the key characteristics of small and medium enterprise or SME in Malaysia. There are 5 main characteristics, starting with the first one is ownership. SME are usually privately owned by individuals, partners or families. They are typically registered as sole proprietorship, partnership or private limited companies like Sediaan Berhad. In most cases, the owner are the main decision makers and are personally invested in the success of their business. The second one is management. SME are often managed and operated by the owners themselves. The owner play multiple roles, acting as both manager and worker. This means decision making is centralized and the growth of the business heavily depends on the owner's ability and efforts. The third one is resources. Compared to large company, SME usually have limited financial and manpower resources. They often rely on personal savings or small loans to start and grow the business. Because of this, new SME may struggle to attract bigger investors or bank support. The first one is organizational structure. The structure in an SME is often flat and informal. There are usually no strict departments, and the owner handles multiple roles. Staff tend to be generalists, meaning they are multi-skilled and flexible in their tasks. The last one is flexibility to change. One of the biggest strengths of SME is their ability to adapt quickly. If a new trend or customer need arise, SME can respond faster than big corporation. However, if the changes require a lot of money, like investing in expensive technology, it might be challenging for SME to keep up. So in summary, SME in Malaysia are owner-driven, flexible and operate with lean resources. But they also face challenges when it comes to growth, financing and scaling up.
I would like to talk about the important role that small and medium enterprise or SMEs play in Malaysia's economy. First, let's look at their economic contribution. In 2023, Malaysia's micro, small and medium enterprise, known as MSME, contribute a total of 613.1 billion ringgit to the country's GDP. That's a significant 39.1% share of the national GDP, and it represents a 5% growth over 2022. What's more impressive is that this growth outpaced the national GDP growth of just 3.6%. The second one is SMEs are the backbone of industrial development in Malaysia. They serve as suppliers, vendors, and distributors for larger local companies and multinational corporations. Their role in the supply chain is essential in sectors like manufacturing, technology, and services, supporting both local and global business operations. Finally, let's look at labor productivity. In 2023, productivity measured as value added per worker rose to 78,035 ringgit, marking a 1.5% increase from the previous year. This shows that SMEs are becoming more efficient and competitive, thanks to improvement in skills, technology, and innovation. In summary, SMEs are not just a part of Malaysia's economy, they are a driving force behind its growth, industrial strength, and productivity. Thank you.
Even though SMEs play many roles in economic development, SMEs sometimes face difficulties and obstacles in securing bank credit. There are several reasons why it's difficult for them to secure financing, including first, unsatisfactory financial track records and poor credit history, second, perceived high risk, and thirdly, high cost of borrowing. Let's look at the first obstacle, which is unsatisfactory financial records and poor credit history. This issue often signals a lack of stability, responsibility, or reliability in the eyes of lenders. To better understand this, let's break it down into three key areas. Firstly, a record of persistent losses means that the businesses has been operating at a loss for an extended period. This raises an area of concern about whether the business can sustain itself in the future, let alone repay a loan. We see this often in retail businesses like small convenience store or boutique shops. With rising rental costs and stiff competition, many struggle to stay profitable month to month. Another example is cafes and food trucks in the F&B industry. These businesses usually face high daily costs, rent, staffs, supplies, and even minor issues like food waste or price sensitivity can eat into their profit. From the bank perspective, if financial records consistently show losses, even if provided in unaudited form, it reflects a risky and unstable business. Secondly, low capital commitment refers to situation where the business owner has not invested much of their own money into the business. This can signal to banks that the owner lacks confidence or long-term commitment. This issue is especially common among micro enterprises such as home-based baker or small online sellers, where operations are started with minimal capital and run informally. Even in structures that set up like franchise businesses, some owners rely almost entirely on borrow money to get started. When banks see very little owner's equity in the business, they question whether the entrepreneur is truly invested financially and mentally in its success. Banks are more likely to approve loans when they see that the owner has skin in the game. Without that, trust is harder to build. Thirdly, excessive leverage and a history of delinquency or default. A serious concern for lenders. When a business already has too much debt or a poor repayment record, it signals a high risk of non-repayment. For instance, construction SMEs, which often operate on credit and take loan for equipment and material, If a single project is delayed or cancelled, cash flow is disrupted and loan repayment are missed. Even though some banks accept alternative documents like bank statements or unaudited accounts, these issues still show up. A poor credit history is difficult to overlook, no matter how flexible the documentation requirements are.
Now, I will explain the next obstacle that prevents SMEs from securing bank credit, which is perceived high risk. Let's start with why SMEs are seen as unreliable borrowers and high risk. Many SMEs have a short business history. They might have just started operating within the last year or two. This makes it hard for banks to trust that the business is stable or sustainable. Also, the failure rate among small businesses is quite high, especially in the early stage. Banks know this, so they are cautious. On top of that, most SMEs have limited cash reserve and small profit margins, meaning they don't have enough saving to fall back on if something goes wrong. SMEs are also easily affected by economic conditions like inflation, currency changes, or market disruption. A small change in the economy can greatly impact their income. And finally, many SMEs depend on only a few regular clients or operate seasonally, so their income can be unpredictable. Another important reason why SMEs face difficulties in securing bank credit is the high cost of borrowings. Unlike large corporations, SMEs are usually seen as higher risk borrowers. Because of that, banks often charge higher interest rates, add extra processing fees, and may require additional conditions like guarantor or insurance. All this increase the total cost of the loan. For a small business with limited income or tight profit margins, even a slightly higher interest rate can make the loan too expensive to afford. Some business owners end up rejecting the loan offer themselves, while others may struggle with repayments later on, which affect their credit score. This high cost discourage many SMEs from applying for bank financing in the first place, and is one of the main reasons they continue to rely on personal savings or informal loans from family and friends instead. In short, even if a bank approves a loan, the term may be too costly, making the credit inaccessible in practice.
In conclusion, small and medium enterprise SMEs are a crucial part of Malaysia's economy, contributing significantly to GDP, employment and industrial development. Their unique characteristics such as private ownership, centralized management, limited resources and high flexibility enable them to adapt quickly in a competitive business environment. However, despite their strength, SMEs continue to face significant challenges in accessing bank credit due to unsatisfactory financial records, perceived high risk, and the high cost of borrowing. Addressing these challenges is essential to unlock the full potential of SMEs and ensure their continued growth and contribution to national development.